from this project, from this product, sorry. Next slide, please. Okay, the outline for this afternoon would be to introduce Deutsche Bank to you. I'm sure many of you have never heard of the bank and have never seen an ATM machine of Deutsche Bank here in Cebu. So we'll share with you what Deutsche Bank is, how we've grown our business here in Manila, what our competitive strengths are, and what we expect from the market in 2013. Then we'll share with you the two products that we manage, the managed fund and the Pioneer Equity Fund. Then we can talk about strategies, winning strategies that have worked for us during the past 5-7 years, and what we think will work for 2013. So Deutsche Bank, Deutsche Bank is Germany's largest bank, founded in Berlin in 1870, set foot in Asia in 1872 in Yokohama and in Shanghai, and today has about 100,000 employees working in 70 different countries in over 3,000 different branches. We are proud to say that despite the global financial crisis, Deutsche Bank remains rated A by leading credit rating agencies such as Standard & Poor's, Moody's, and Fitch of London. This slide shows you how we are organized as a bank. And on the left side would be the private clients and wealth management group, which is now catering to both private individuals as well as institutional clients. And on the right side would be our global markets / investment banking group. And below would be our different brands in the asset management world, which focuses on institutional, retail, and insurance clients. In the Philippines, Deutsche Bank has been here for over 35 years now, starting off as an offshore banking unit, then a rep office. And in 1997, when then President Fidel V. Ramos opened the banking sector to 10 additional foreign banks, Deutsche Bank was one of the 10 that was given a license to operate a commercial bank. And the reason for that is we stayed here through thick and thin. During the most difficult times of 1983 to 1986, Deutsche Bank remained in the Philippines. And last year, we got our universal banking license, which meant that we committed more capital to the Philippines. In fact, at the fort in Makati, we have our outsourcing unit, which employs more than 2,000 people today. And so all MIS accounting reports of Deutsche Bank globally now come from the Philippines. In 1997, we started off this business, which we call the Trust and Investments Group. And we started it off from zero. We got the trust license, we started from zero, and the past 16 years have been very good to us. This shows the growth from less than $500 million in 1997, when we got the license in May of 1997, to over 70 billion today in Philippine assets. This excludes the offshore mandates, wherein funds are managed in Frankfurt and in New York. All of these are just managed here in the Philippines. So today we are in the top 10 in the industry, and we are the youngest institution among the top 10, where the top 5 are all the large local banks that have been here for 50 to as long as 150 years. This slide just summarizes the investment process that we employ at Deutsche Bank, regardless of the size of the funds. And it always starts off with good research. During the past 16 years, we've seen a lot of crises, both domestic and foreign, that have hit a lot of financial institutions. And it all starts off with good research. Because once you do your homework, then you can come up with an asset allocation mix that answers the question, where do we put our money? Then we trade it on a daily basis and monitor it. And at the end of the day, we go back to the client. And in this case, it's Pioneer Life. So every quarter, we report to Rolly and Molly to tell them how our strategy has worked or hasn't worked, and what we intend to do moving forward. Based on our outlook, what will be our change in the strategy. So, what are our competitive strengths? The first one is the people. Deutsche Bank has a very low turnover ratio. In fact, we always kid each other, people grow old at Deutsche Bank. When I joined the bank in 1997, I didn't have any gray hair. Ngayon, naputi na, no? Namuti na. Okay? Our team, we set it up, 7 of us, more than half of the team remains intact. Yung umalis lang, yung mga babae, nag-housewife, no? They decided to take care of the family. So, hindi lumipat sa competitor. No? They didn't move to the competitor. They decided to give more time to the family. And that has been the story of Deutsche Bank, not only our group, but even other departments, it's the same. And we are staffed by very experienced professionals. Our team, before we worked at Deutsche, we were already a team at City Trust. We were already working together for more than 7 years as a team. And so when we moved, we also moved as a team. That was the first time in the Philippine financial market that happened, wherein a whole team moved, no? And set up a group. Ito yung akong handbook page ba? This is what Rolly shared with you in introducing me. We've been very fortunate to receive a lot of recognition from international observers. So we were named the Chief Investment Officer of the Year in 2011. So we received that award in February. And then we were named the Fund Manager of the Year for long-term fixed income funds. We were one of only 8 in Asia that was recognized last month by the Asset Magazine in Hong Kong. And then next week, I'll be flying to Singapore, where not only me, but my team was named one of the most astute investors in local bonds in the Philippines. So this reflects that number one, the investment process works, and I have managed to cascade down to my staff the learnings of the past 2 decades. Then the investment process. The investment process that we showed you earlier, we are very proud to say, has withstood all the crises that we've seen, both domestic and international, during the past 16 years. During this period, none of our investments have gone sour. Okay? None of the counterparties that we deal with, meaning the banks, the stockbrokers, or the investment houses that we deal with, have ended up in the front page, closing shop. Okay? And the reason for that is that we regularly review both our counterparties and our investments. And so during the Asian financial crisis, before a bank hit the front page, we already removed it from our list of accredited counterparties. So these are the proactive steps that we take to make sure that we give you good returns and allow you to sleep soundly at night. Okay? And that's why when I show you the page later on of our list of corporate clients, we are very proud to say that we have the market leaders in almost all sectors of Philippine business. Thank you. And then performance. When we face investors or potential clients, in this case, individual clients, okay, we don't go out and say, we are number 1 in performance. Okay? And the reason for that is that our goal is to be among the top tier and to give you stable and consistent returns. The problem with bragging to be number one is that to maintain your ranking as number one, you usually have to take excessive risk. And at Deutsche Bank, we go out of our way to manage the risk so that our clients will be comfortable and could sleep soundly at night that the fund manager is taking good care of your money. These are sample lists of our clients. And many of them have been with us from the beginning, 97, 98, and 99, which were the Asian crisis years. In the pharmaceutical industry, we have practically everyone that's there in the pharmaceutical sector. In the financial sector, our biggest competitor, Citibank, gave us the mandate to manage their largest part of the retirement fund, which is for their officers. We are also managing part of the BSP Provident Fund on the equity side. And this year, I was informed that we're among the top, among their 12 different fund managers. And then we also have a sprinkling of schools. We have Ateneo, LaSalle, AIM, okay? And a few Japanese companies like Toyota and Fujitsu, and a few American companies. Okay, enough of the humble. You're not here to listen to me brag, right? You're here to listen to my ideas, what I think will happen moving forward. And so we started off with our take on the global outlook. Okay? In mid-September, we came out with a research paper that said that we are cutting our 2012 and 2013 growth forecast. We're cutting it because the US and Japan has disappointed big time this year. During the next 2 weeks, both the World Bank and the IMF followed suit, and that shook Wall Street. But our forecast is even more bearish than the IMF forecast. When you look at the chart on the left, it practically tells you that the US will be stuck in low gear, that Europe will be stuck in recession, and the growth region will remain Asia ex-Japan. That could be bad news for the exporters in this room, okay? But that is the reality. Huh? So, during the past 2 months, central banks around the world cut interest rates and continued what we call monetary easing. These measures are intended to try to lift the economy, to encourage growth as we enter 2013. So in the US, they have what we call QE3, quantitative easing 3. In Europe, the ECB launched what we call bond buyback program. So they buy the bonds to prop up prices, to bring up prices, and to bring down interest rates so that the economy could recover. And the same holds true in Bank of Japan, because the Japanese economy in the third quarter shrunk again by 4%. Okay? So in the next slide, we see that the US is indeed stuck in low gear. During the campaign period, many clients asked me, "Friends, what do you think will happen to the US election? Who do you think will win?" And I told them, it doesn't matter who wins. Okay? The Deutsche Bank paper predicted Romney, but I said, I believe Obama will win. And he did win. But I told them, and I'm telling you now, it doesn't matter. Because on the next day, after elections, November 7, the Dow Jones Industrial fell by 300 points. And that reflected the main risk at the bottom, which is what we call the fiscal cliff. Okay? The US is headed for a fiscal cliff. Bangin ba? Okay? Why fiscal cliff? Because $600 billion in expenditure cuts. Okay? Government will cut expenditures and raise taxes Okay? As we enter January 1, 2013. And this, if implemented and total as a whole, will result to the US being back in recession in the first half of 2013. Okay? So, what do they have to do? Number one, why are they in this predicament? 2 years ago, the US Congress approved these measures because they're under threat to be downgraded and be stripped of the AAA rating. So they had to act fast. But in acting, they forgot to think. Okay? So this is staring them in the eye. If they implement it, if the US Congress does not stop it, then we're headed for recession. If they do not implement it, Moody's will remove AAA rating. Okay? And so what would likely happen will be the middle road. Okay? The Democrats and the Republicans have to reach a compromise, have to settle for a middle ground. And the middle ground will bring them to low gear, meaning mudly through scenario wherein their central bank, Chairman Bernanke, has already announced that they will keep interest rates exceptionally low, meaning close to zero, until 2015. 2012 pa lang tayo, he can already tell you what he'll do until 2015. Meaning, the indicators he sees right now is very alarming. In fact, I wouldn't be surprised if they launch QE4 next year to get out of the recession. In Euroland, Deutsche Bank's home market, don't be alarmed. The chart is not upside down. It really looks that way. Okay? Entering this year, we said Euroland will be in recession. And indeed, 12 economies are in contraction. So, the good news is that Germany is not in recession. Okay? That means I'll still have a job next year. Okay? That's the only good news I see. Germany will continue to grow, but by only 1%. Okay? And Germany is carrying the whole load of the whole region. Okay? Next year, we're entering the 6th year wherein Greece will be in recession. And Standard & Poor's says -10 to -11% growth for Greece. Imagine 6 years. This year, the focus was on Spain, where 46% of the youth are unemployed. They don't have jobs. 4.6 for every 10 young people do not have jobs. Okay? And for the whole region, the unemployment rate is above 22%. Except for Germany, which has 6.8% unemployment rate. Does this ring familiar? Of course. We came from that situation. Okay? 1983 to 86, stagflation years of the Philippine economy. Stagnating economy, high inflation rates. Right? Asian crisis. The whole Asia-Pacific region was in recession. Only the Philippines and Indonesia managed to post positive growth. Right? In 2008 again, global financial crisis. Only Indonesia and the Philippines did not contract. So we know how it feels. In fact, many in this room graduated without jobs in the market. Right? 80s and early 90s. So many of our colleagues didn't have jobs. So we know the situation. We also know that it doesn't take 1 year to solve a problem like that. In fact, it took 10 years for Asia to get out of the Asian financial crisis. It took us 10 years to remove the NPLs, the non-performing loans, from the Philippine banking sector. It took Japan 2 decades, 2 lost decades. It took Latin America 15 years. So what makes the policymakers in Europe think that they can get away without the pain? So next year, 6th year, expect this to last 10 to 12 years. Sakit. Galit sa ating mga exporters. But that is the reality. No? The only positive news I can think of is that it will bottom out and they'll hit zero growth by next year. The worst case is that recession will last until the first half of next year. When we look at Asia, it's a different picture that we see. 6 months ago, in my report to Rolly, I was talking about robust growth in Asia, meaning malakas, strong. Now I'm talking about a slowing growth in Asia, led by China, which has slowed down from an average of 10.1% over the last 7 years to 7.5%. But full year, they will still hit 7.7%. Okay? The Philippines, in the second quarter, we slowed down from 6.3% to 5.8%. Okay? Expect the third quarter number, which will be released by month end, to be closer to 5.25% to 5.5%. Okay? Now, when you look at Asia, it's not the same story all around the region. On the leftmost side are economies that we label as low beta economies. Meaning these are economies that are driven by domestic consumption. China, India, very strong population. Indonesia, the Philippines, domestic consumption driven. On the rightmost are we call high beta economies. These are driven by exports. These are the export dragons of the 90s. Singapore, Hong Kong, Korea, Taiwan. And therefore, at a time like this, where external demand from the US and Europe has collapsed, they are the most vulnerable. Okay? Nevertheless, the region continues to grow because intra-regional trade led by China and the ASEAN 5 has more than doubled during the last 5 years. And number two, domestic consumption across the region continues to grow, fueled by the high savings ratio in Asia and government pump priming. All the governments in Asia right now are so well positioned to support the economy. When we look at stock markets around the world, not only in Asia Pac, but around the world, this year, what do we notice? 15 years after the Asian financial crisis, the place to be is in Southeast Asia, with Thailand and the Philippines being the best performing markets in the world. Post QE3 announcement in September, Germany rallied, the US stock market rallied, and the North Asian markets such as Hong Kong, Korea, Singapore, and Taiwan rallied as well. From negative to marginal positive territory, they are all now in double digits. But still, nothing beats the Philippines. Last year, when many markets were in negative territory, the Philippines was the best performing stock market in Asia Pac, up 4.1%. And so for the last 3 years, the Philippines has been the best performing market in the region. Why? Huh? Because of Cebuanos? Huh? Masipag? Okay. Why? Because of the domestic consumption-driven story of the Philippines. Exports, unfortunately, has not been a driver of growth of the Philippine economy for the past 28 consecutive quarters now. Okay? It is domestic consumption that drives the Philippine economy. It's like the US economy. Okay? So, investors like that because they know that the US and Euroland are in trouble today. When we bring it down to our shores and we look at the Philippine economy, we're looking at 5.5% GDP growth this year and in 2013. 6.1% in the first half, but as I mentioned, it is slowing down. Okay? And so we cannot be complacent. We continue to push both the government and the private sector to continue with the expansion projects. Okay? What was the driver of growth in the first half? Domestic consumption and government spending. Government consumption is fueled by OFW remittances of $20 billion and the growth of the business process outsourcing industry. Huh? It has now reached Cebu. Traffic na? Outside? Pati gabi, traffic? Even in the evenings? Sorry. In the evenings, it's also traffic. The BPO story is all across the archipelago. From Baguio to Bulacan to Manila to Cebu, Bacolod, and Davao. Okay? These kids earn so much. 18 to 25,000 fresh grads, all cash. No wonder they can afford to buy Starbucks every day. When we graduated, we couldn't buy, no? We couldn't afford to pay 120 pang kape. 120 pesos, 250 for a cup of coffee. Okay? Then they buy a lot of bags, they buy a lot of shoes, and now they're buying condo units. And they're only what? 24 to 30 years old? How old were we when we bought our first property? Uban na, no? Okay? Today, they're so young, they can buy 2 to 4 million peso condo units. What will be the growth drivers moving forward? Sorry, I forgot. The growth drivers moving forward will remain BPO, tourism/gaming. Ba, legal ng gaming ngayon? Casino? Legal na. So next year, 2 big casinos will open in Manila. So we have now Resort World. Okay? Next year, we'll have Soleil of Ricky Razon. And then you'll have the Bell LR Casino, where they partnered with Melco, City of Dreams in Macau. And then Azure, number 4, the Japanese partner of Wynn Resorts, left Wynn to go to the Philippines. Imagine, this Japanese must be crazy, no? He fought Wynn to go to the Philippines. Okay? The investors are beginning to see something that maybe we inside refuse to see. Okay? Japanese apparel will open 50 shops in the Philippines during the next 2 years. 50 shops. Okay? They must be seeing something. Sorry, go back, sorry. So inflation. Inflation has always been a problem of the Philippines. Very similar to Latin America. Okay? But today, inflation has been nipped in the bud. Okay? We call this benign. 15 years ago, our average inflation rate was at 9.8%. Okay? Today, it is 5.2%, and year-to-date, we're hitting 3.1%. This is good for businessmen like you, bad for wage earners like me. Because my salary increase is linked to the inflation rate. So in the 90s, I used to get 15-20% increase every year, sometimes 25 to 30. Today, it's 3.1 plus 0.5. Less than 5% increase. When I have to go to Cebu to talk to the investors like you. So this is a good, very, very good news for businessmen. Okay? Now, the bad news next year is that we're headed for a mild drought. In fact, it's only November. It's very warm already, yeah? It's like summer. Okay? And this will last until May. Okay? So the effect will be negative on agricultural output and could cause some pressure on food prices. But full year next year, we're seeing it won't even exceed 3.5. Okay? So that brings me now to the next slide on Philippine interest rates. Again, the lowest ever since all of us combined started working or started our businesses. Okay? 7 years ago, the 10-year fixed rate treasury note, meaning if the government borrowed for 10 years, the rate was at 10 to 12%. Today, the 10 years is at 5% and falling. The 20% is at 6.125, and this week it fell below 6. So it's good for businessmen like you. It's good for the young professionals who are now able to borrow easily from the banks to buy their first car, to buy their first condo unit. It's tough for me who has to invest your money. Because if I gave you 2%, you'd walk out the room today. Right? Okay? Again, 7 years ago, the time deposit rate was at 8 to 10%. Today, what's your time deposit rate? 2% and falling. Gross. Okay? And the dollar rate, 30-day, 0.25. Just leave it in your drawer. You won't have hassle. Okay? Just buy a vault, put it in your room. Put your dollars in there. You're better off. You won't get any charges.
Yeah.
Right? Because in some banks, when you withdraw, they will charge. They will charge you for withdrawing your money. It's crazy, huh? Okay, so what am I showing here? I'm showing you that all the bullet points show ito yung sinasabi na the Philippine fundamentals has drastically improved. In fact, we have switched roles with the developed markets. Huh? Today, the Philippines can borrow at very cheap rates. Okay? The chart on the left shows you the debt to GDP ratio, which has gone down from 74% in 2004 to 50% when we ended 2011. You know what the debt to GDP ratio of Japan is? 210%. Of Euroland, 190%. Huh? And the US, it's over 100%. And they're the developed markets. And we're at 50%. Okay? They're AAA, and we're one notch below investment grade. Okay? Now, when will we get investment grade? We'll get investment grade status when that number goes to the mid-40s. Meaning 43% to 44% debt to GDP ratio. Why is that rating so important? In fact, when you look at it practically, it doesn't matter today. Because the Philippine government can already reap the benefits in the market. It's already able to borrow easily. It's able to borrow at cheap rates. But, you know, banks are really like that. When you don't need the money, that's when you can borrow. Huh? When you need the money, they don't want to lend you. Huh? Okay, right? So today, starting last year, the Philippine economy has been transformed from a net borrower to a net lender. This year, we are lending the IMF $1 billion. When we went to school, we were running the streets because we were borrowing too much. This month, the IMF Managing Director, Lagarde, is coming over to see not how much the Philippines needs, but to see what else the Philippines can do to help Europe. Last week, instead of borrowing dollars abroad, the Philippines borrowed pesos and bought the dollars from the central bank. The central bank said, why will you go abroad to borrow $750 million? I'll lend it to you. You pay me. I have enough dollars, which we'll see in the next slide. Okay? So a really different picture from when we were in school. Huh? And I didn't imagine that this would happen in my lifetime. Okay? The transformation of the Philippine economy. My last point there, the fiscal deficit. Again, something we rallied when we were in our youth. No? The deficit to GDP ratio in the Philippines is at 2% and falling. Next year, it will be below 2%. And in 2014, it will be less than 1%. Okay? Compare this again to the US and Euroland, which is at 8%, and Greece, it is closer to 15%. Okay? That is the load of your deficit, meaning government spending more than it collects, okay, relative to the GDP. The smaller that number, okay, the stronger your financial position is. The Philippine peso, kalaban ng mga Cebuano. The Philippine peso has now been transformed from a weak currency to a strong currency. This year, the Philippine peso is the second best performing currency in Asia-Pac, up more than 6.5%, and it's only the same dollar which has appreciated or gained more than the Philippine peso. In the first half, we were the best performing. Okay? But when we say best performing, that's bad for the exporters. Huh? Okay? During the last 8 years, the Philippine peso has appreciated by 27%. 5 years ago, I told all my clients, let's sell all our dollar assets. They thought I was crazy. Sabi ko, the Philippines is transforming. That story will change. They thought, pumikit ako ng juice. You're crazy. Fritz, what are you saying? I told them, the Philippine pastime of buying dollars will not work anymore. Stop it. You'll get hurt. Okay? So today, we see the peso has appreciated by 27%. And next year, and over the next 3 years, it will appreciate even more. Some are saying, sinusuportahan kasi ng BSP, kaya malakas ang peso. Wrong. Sinusuportahan ng BSP para hindi masyadong malakas ang peso. Okay? The BSP is trying to manage the appreciation. Okay? Why? When the Asian crisis started in 1997, the Thai baht and the Philippine peso were at parity. We were both trading at 26. Today, where is the Thai baht? 30. Where is the Philippine peso? 41.10. Right? Therefore, when the academicians, the professors at UP School of Economics say, if left alone, the Philippine peso should be at 35 today. Where will your business be if the Philippine peso was at 35? No? Hirap, no? Okay? That's why the central bank is trying to manage. But the trend is too strong to stop. Okay? So next year, prepare for 40 to 41, and at some points, it will break 40. Okay? My best bet is it will be in May. It's going to break 40 in May. Yan, fearless forecast yan. The next time I come back here, batuhin nyo ako pag hindi mangyari yan. Okay? Next. And so the stock market has rallied. 23 new all-time highs recorded this year alone. Second best performing market in Asia-Pac, in the world this year. Best performing in Asia-Pac last year. Okay? Why? Again, some people will say, tinutulak lang yan yung Malacanang. Okay? No. The stock market has always been a forward-looking indicator. It's not what is happening now. It is what will happen in the future. Okay? Many ask me, Fritz, is the stock market expensive? Yes, it's expensive. We're the second most expensive market in Asia, outside of Taiwan. Yet, many investors, both local and foreign, are waiting to come in. Everybody's thinking, I'll buy on dips, meaning I'll buy when it goes down. And so as you'll see in the chart, it hasn't gone down. Okay? The corrections have been very shallow. Okay? In October, Deutsche Bank held our first ever DB access in Manila. 60 Asian fund managers came over here. A total of 100 fund managers packed the Manila Peninsula Hotel. In September, we held one in London, and all the European fund managers went there soon. What's the story? The story is, the good fundamentals, the macro picture, will cascade down to the micro level, such as all-time low, low interest rates, such as benign inflation. That's good for doing business, right? And so when you look at the E, the earnings, it will continue to expand. Conglomerates, which never talked before, are now partnering so that they get a bigger part of the pie. Take for instance Ayala Corp and Aboitiz Equity Ventures of Cebu, partnering for the Cebu Airport. Ayala Corp and Manny Pangilian's Metro Pacific Investments, partnering to prepare for the infrastructure projects. Okay? So, when you look at CAPEX, all of your investors, you know CAPEX, capital expenditure, has doubled from the 2008 levels to the 2012 levels. In fact, when I go around and talk to the listed corporations, many of the expansion projects will be completed in 2014 and 2015. So when an expansion project is complete, what happens? Your earnings go up. Unless the whole economy collapses. Right? Unless Filipinos don't give birth anymore. Posible, no? Even with the RH bill. Huh? Impossible. Diba? So 2.4% birth rate per year. Okay? 95 million Filipinos by next year. Okay? 100 million Filipinos by 2015. What? They won't eat? Huh? They'll stop using the cell phones? Huh? They won't take a bath? They won't turn on the electricity? What? Okay? And therefore, investors see that. In fact, when you go outside of the Philippines, the regional themes are threefold. Number one, demographics. Number two, urban shift. Number three, population growth. In all of these three, the Philippines ranks high. Demographics, okay? Politicians know this. 60% of the population is below the age of 25. Okay? Population growth, 2.4%. Urbanization rate rising, catching up to Malaysia. Why? Because as you build more condominium units and infrastructure, people can now shuttle back and forth even if they live in the suburbs. Okay? Like now, no? Mandaue and Lahu. Parang lapit na, no? Before, binabangka. Diba? Now, you're there. Okay? Okay, next. So now, let's go to the two funds. That I had to tell you the story so that you appreciate the strategies that I'm employing. Huh? And so that you understand why it's making money. The reason why a lot of people got scammed again in Mindanao last month is that people never learn. Someone offers you 60% return, you get all excited. Right? Oh, where's the Malaysian today? In Malaysia. The NBI cannot get hold of it. Right? But the problem with these scams is that they get big money from educated people because the scammers know when, pardon the French, shit hits the roof, they get to flee and nobody will complain. Right? Because mahiya, no? Tali-talino mo, na-scam ka. Nakatira ka sa Ayala, na-scam ka. So it's people in plush subdivisions that get scammed. Okay? So let's share what the two products are. The first product is what we call a managed fund. It's a balanced fund. It has both bonds and stocks. Okay? And as of end of September, we had close to 60%, 58% in equities, Philippine equities, and the balance in bonds. Okay? The last 2 weeks, I've been taking profits. This has gone down to about 56, 57%, but still invested in equities. On the next slide, we'll see that on the bond side, the 40% or so that's invested in bonds, when you look at the table on the left, average duration shows you that it has been growing. That is a reflection of our strong view that Philippine interest rates will go down. Okay? And the tipping point was in 2005-2006. 2005, when the EVAT on petroleum products was being deliberated, many said, hindi papasa yan. And if ever the law is passed, it will not be implemented. We had a different view. Our view was it will be passed and implemented immediately. And so we positioned long. Prior to that, many fund managers would only position until 10 years. Kasi kakatakot sa Philippines, unstable. We said, no, this will be the tipping point. Okay? So you see the duration has gone from 3.5 years to closer to 8 years today. Okay? And the average life, the maturity profile, has gone from 5.4 years to close to 13 years. Meaning we're positioned on the 20 and 25 years. And we practically sold our 4 years and shorter. That has shielded us from interest rates going down because our money is already locked at the high levels. And that's the reason why we got the Fund Manager of the Year for long-term investments. Okay? Because that was so different from many views that were in the market. Okay? Next. This slide shows where we're invested in the stock market. We're most heavy in the holding companies. Okay? Why? Because entering the year, we said that the holding companies will lead the investments in the growth areas. Okay? So we're very heavy holding. We also said banking and property will do very well. And consumer, which was in negative territory in the first quarter of this year, we said will do better. And so it did better, and we're very heavy in consumer. Okay? This shows the performance as of the first 10 months of the year. The total ROI was 15.33% against the benchmark, which is 13.5%. The benchmark is like, you know, if you were a hurdle runner in the track and field, yeah, you have to jump over something. Okay? Our benchmark is what we compare ourselves to answer the question, are we doing well or are we lagging behind? And here we see that we have outperformed by 1.85%. As of last night, when I computed the returns, total return is now at 16% against the benchmark, which is close to 14%. So there's an outperformance now of 2%. Okay? This chart shows how the NAV, the net asset value, or the price of the fund, has behaved. And notice that the corrections have been very shallow. When I briefed our agents in March, I told them the market is too strong. Your best bet would be in May and in September. This is September, the lowest point there. That is the lowest that it has been this year. Okay? As of November 5, the NAV was at 1.5355. Last night it was at 1.557. Okay? Next slide. So that's the first fund. If you think that you are conservative, you go for the first fund. Okay? Because it has bonds, it has equities. And it's up to me to shift if I put more in bonds or if I put more in equities. The second product is what we call an equity fund. All the investments are in the stock market. Okay? So as you'll see here, as of end September, I was practically fully invested, 98%. In fact, if someone withdrew, I'd have to sell to fund a withdrawal of 7 million. Okay? But after my roadshow in Manila last month, nag-dilute ako because the inflow started to come in, okay? Many in the audience believe the story, so they put more money here. And so my equity exposure is now down to 80%. Okay. Also, I've been selling the last 2 weeks. I told the audience back then, last month, you have to give me more money. Otherwise, I won't do anything anymore. I've already invested until next year. Okay? So if you want me to work, you give me more money. So they started contributing more. Okay, next slide. And just like in the first one, the allocation for equities is very similar. Okay? Still very heavy on holding companies, close to 26%. Okay? Financials, close to 17%. Property, 18%. Okay? And then power at 11% and consumer at 14%. Why are you taking down those? No more. Just give me the money. I'll invest it for you. Right? Does that make sense?
Yes.
Why? Because if you are an individual, okay, you cannot invest in so many stocks. Right? Number one, you don't know what to buy. Okay? Who among you has a research platform at home? Okay? Anyone has a research team at home? I doubt. I haven't met anyone with a research team at home. Okay? Number two, you're all busy with your profession or with your business. In the stock market, if you're not glued to the screen, you can lose a lot of money. Okay? In fact, even in my trip here this morning, you can ask Rolly, at 6:30 in the domestic airport, I was already listing down my trades. As soon as I landed, I gave my trades to Manila. Okay? Before I came down here from the room, I was tracking my investments. You have the time for that? You have the appetite? You want to have ulcers? This is the best way to get ulcers. Okay? So, the same strategy, but different allocation mix. Okay, as of end October, the return was at 24.64. The benchmark of PSCI, the Philippine Stock Exchange Composite Index, was at 2407. We outperformed by close to 60 basis points. As of last night, my total return was at 25.6. The index was at 24.6 or 8. And so the outperformance grew to over 100 basis points. Okay, man? Okay. So, what else do we have? In the next slide, we show you that the behavior of the NAV is very similar. See? The correction was in September, but not much. Again, as of November 5, the NAV was at 1.78459. As of last night, I think it was at 1.795. Okay? The NAV is going up even if the US Dow Jones Industrial Average has lost more than 500 points. Close to 700 points. On November 6, US election, it was trading at about 13,400. A week before the elections, it was at 13,700. November 7, the day after the election, it went down by 300. Today, the US Dow Jones is trading below 13,000. It's only at 12,700 now. Which reflects the fears on the US fiscal cliff that we just talked about. And yet, your Philippine stock market is not correcting. Well, today, it corrected 36 points. When the Dow Jones fell by 300, our market fell by 14. The next day, the Dow Jones fell by another 1.5%. The Philippine market was up 9.6 points. Okay? So that behavior is reflected here. That the corrections have been very shallow. Now, many ask me, oh, Fritz, how does your fund perform to the market? To those products that are in the market? So I took up the challenge. Okay, let's see. Okay, I prepared this slide for my client in Arizona. Okay, so this is the Pioneer Equity Fund. This year, 25.2 as of November 5. Okay, against the index, 24.8, it outperforms. Okay? It is among the best performing equity funds year to date. And when you look at 3 and 5 years, again, it is the best performing among the biggest fund managers in the Philippines. Sun Life, Banco de Oro, BPL. Okay? See? This is what we say when we're the all-weather fund manager. Whether the market is up or down, we remain among the top tier. I never brag that I'm always number one. Because I know I cannot be number one always. I also have to take vacation. But, okay, whether you monitor the NAV sheets or the newspaper, I can assure you, you can go and sleep well at night. Okay? Next slide. So, what's our strategy? What's the winning strategy for 2013? I've called it very well, especially the last 4 years. Okay? We've bagged almost all the awards that there is to buy. Okay? So what is the winning strategy for 2013? Next slide. Okay. In line with our view that inflation will be benign, it will only creep up in the first quarter. Okay? And interest rates will remain low and could only creep up in the first quarter, most likely in February. What's the strategy? The strategy is we're taking profits on our bonds this fourth quarter and taking more profits in the first quarter of next year. Okay? The effect of that is that we will realize the paper gains and make it real. And when interest rates flip in the first quarter, most likely in February, we will buy back at higher levels in terms of yield and lower prices. Okay? That's the fixed income strategy. Duration, it will remain low. We will only tweak it a bit as we take profits, okay, on the 20 and 25-year notes. Naturally, the duration will go down. But when interest rates go up again, we will buy again long. Okay? Now, what's the strategy for equities? I believe that this last 3 years is the best time to invest in Philippine equities. And we've seen it. Okay? As the expansion projects are completed in 2014, 2015, okay? What's our forecast? We will see the market end close to 5,600 this year. Not far, we're already at 5,475. Okay? Next year we'll pierce 6,000. Okay? And then in 2014, 2015, that might be the peak. Okay? We will pierce 7,000. Ayan ha? Fearless forecast yan. Okay? And it's all supported by the earnings outlook. Supported by the positive fundamentals, low interest rates, low inflation, growing population, growing economy. Okay? So, what sectors do we bet on? Still the same sectors that we did this year. Holding companies, banking and property, consumer, okay? We're headed for elections next year, yeah? Consumer, media will be the main beneficiaries of elections coming. Okay? Already you're seeing the politicians appearing on some TV shows already. Okay? That's called ad spend. Okay? They're spending on ads. Okay? And so ABS-CBN reported their earnings yesterday. It's already a lot better. Can you imagine? First quarter next year, what the number will be? Okay? So we've been buying already ABS-CBN. We've been buying cement. Okay? We haven't had cement in our portfolio in a long time. We're accumulating cement. We're accumulating ABS-CBN. And yeah, consumer. Next. Why are these the favored sectors? When you look at the earnings during the first half, the growth is in power, banking, holdings, property, and then consumer became positive from negative in the fourth quarter of last year and first quarter of this year. The most challenged is the telco sector, where revenues continue to contract by 4 to 5%. And the reason for that is that everybody now has a cell phone, everybody has a duo SIM card, my yaya, my driver, my laundry woman, everyone, my janitor in the building, everybody has a cell phone. And usually their cell phone is nicer than mine. Right? Okay? So, where will the growth come from? Okay? It will come from broadband. Okay? And this quarter, broadband was up 27% for PLDT, but your wireless is still contracting. Okay? So that will remain challenged. And then your mining got hit with the EO, the executive order, and the correction in global prices. So the volumes were up, but global prices collapsed because worldwide it was priced in that there will be a slowdown, and slower growth means less consumption by China for the minerals. And that's what we saw. And for Felix, just bad luck. Yeah? Patkar mining is closed until the second quarter of next year. They're losing like 4 billion in the second half of this year. Okay? And no new permits will be issued until the law is amended. But how can you amend the law when we're headed for elections? No? Okay, next slide. The last two slides just shows that the upside on the rightmost column remains attractive for the stocks that are in the radar scheme. Okay. The discipline I employ here is a top-down approach. Number one, will there be macro growth? The answer is yes, 5.5% growth this year next. The next question is, what sectors will lead the growth? We showed the sectors. The third is, who are the market leaders in the sectors? Okay? When the upside on the rightmost column is 12% or more, it signals a buy. So if you want to double in the stock market, you use the same strategy. Okay? When the upside is 5% or less, it's time to sell. Never fall in love with your stocks. They cannot hug you. Okay? So, even if I'm so bullish on the stock, when those triggers are hit, I sell. When the upside comes back, I buy it now. Okay? In the next slide, you'll see that there are still a few in the property sector and a few in the power sector that also offer attractive opportunities. Okay? My last slide is a disclaimer. If you at the back cannot read it, it says, do not believe anything he said this afternoon. Thank you and good afternoon.